2022 has been a year to forget for many, but there are some that have taken advantage, and of course, there are some that have changed the way in which they view the markets. We're talking now to the UK's only listed Canadian equity fund focused on high income, admitted to the FTSE UK All Share Index back in 2011. We're talking to the fund manager of the Middlefield Canadian Income Trust. It's Dean Orrico. Dean, welcome. It's good to be able to catch up with you again. It's been about a year, actually, since we last spoke to you. And of course, a lot of water's passed under the bridge since then, including, of course, the largest war to be fought on European soil since the Second World War. And you as a fund manager, of course, listed in London, you have your eye on global events, despite the fact you're focused, obviously, in the Canadian markets. How do you see things as they are at the moment as we look into the meat of 2023?
Thanks for having me, Jeremy. And you're right, it is a very different environment today than it was some 12 or 14 months ago. And I think the world very much changed on February 24th, 22, when Russia decided to invade Ukraine. And I think it's created a continued momentum in inflation because it really has disrupted global trade, which in essence has resulted in higher commodity prices and higher input prices. And I think it's also created some geopolitical impacts in that what was a 30-year trend of globalization is now beginning to unwind. And as Janet Yellen said a few weeks ago, that we are now in a period of friendshoring, which is a broader term related to onshoring. So I think it's really going to be over time, and it's not going to be happening in the next year or two, but over time, somewhat of an unwinding of some of these supply chains that have been established beginning when China joined the WTO, again, some 30 years ago. And I think it's also created a different perspective on places like Canada, which have an abundance of natural resources, oil, gas, minerals. And I think it's creating a renewed positive view on some of those resources coming from places like Canada, and a renewed positive view on the Canadian economy generally.
Interesting, isn't it, when talking about these broken supply chains, that effectively puts a brake on the economy. At the same time, you've got central banks raising interest rates across on this side of the Atlantic. Of course, we're all at it, as indeed, of course, in North America, both the Canadian Central Bank and the Federal Reserve are hard at it as well. How has this impacted things? And do you think this is as a result of what we've seen in terms of the Russia-Ukraine conflict, or has that exacerbated the situation? What's been the root of the cause of this rise in rates?
Well, I think it's certainly been more the latter. It's exacerbated the situation because you had inflation really run up early on because of the supply chain issues that were stemming from the pandemic. And then you had this pent-up demand, which created this demand for initially goods and now services. So that's certainly been a factor. And then the icing on the cake really has been the war in Eastern Europe, which again has created more disruption to the supply chain side, the supply side of the equation, that has exacerbated the situation. So I think if we can start getting the supply chain issue under control here, and I think in the fullness of time we will, I think that will have a real disinflationary impact that maybe cause central bankers to take their foot off the accelerator here on rate increases, because the supply chain normalization will eventually start to bring down prices on its own.
I just want to bring up a price chart of the Middlefield Canadian income price chart that we've got here. As I said, it's London listed. We're currently trading at 119.50. In fact, last year I said 2022 was a difficult year. In fact, at some part, you managed to steer the fund to a really good high about June last year. We've since seen some of the money taken off, and indeed, in fact, we ended up last year pretty much where we started. But we are well away from the COVID lows that I've got here on the left-hand side of this chart. How do you describe the investment environment at the moment, and what are you doing as a fund manager to try and take advantage of the situation you described?
So when you think about the backdrop, and we've just discussed it a little bit so far this morning with higher rates, inflation that I think will remain higher for longer, And I think that's primarily as a result of some of this friendshoring and onshoring that's going to be occurring in the coming years, which in essence will result in higher prices passed on to consumers. I think it's creating a view that we want to get exposure to sectors that will benefit from that type of environment. And I think Canada offers a lot of those benefits. So as a result, our portfolio mix continues to be focused on Canada as opposed to the US. We can be up to 40% US equities, but we're actually about 95% Canada and only 5% US equities right now because we have this positive view on the Canadian backdrop. And that includes areas like financials. We have some of the strongest banks globally. And those banks are not only dominant players in the Canadian market, but they're also dominant players in the US market and in Latin America. In fact, Toronto Dominion Bank, which is one of our favorite holdings, it's about to complete the acquisition of First Horizons Bank in the US, which will make TD the fifth largest bank in the US market. Bank of Montreal, another one of our favorite holdings, is just completed the acquisition of Bank of the West in the US as well. It's a $20 billion acquisition, making it a major player in the US market. So we like that part of the market. On the energy front, we continue to have healthy weightings in both producers of energy as well as energy pipelines. And the producers would be primarily focused on oil because we continue to have a very constructive view on oil prices. And to a certain extent, that's a result of what's happening in Eastern Europe. And then in addition to that, the pipelines, which are very stable dividend payers and dividend growers as well, that are dominant players within the North American pipeline sector, where we know it's very difficult to build new pipelines. So you want to own those companies that already have pipe in the ground and are benefiting from that cash flow stream and dividends that are in that 6 to 7% range.
You were quoted actually middle of last year saying that oil and gas companies have unheard of levels of cash. Is that still the same situation as we look into this year? I ask this because I know that part of what we saw then was the fact that these companies weren't investing in pipeline. There is now a little bit more of an appetite, I think, to increase capex. I think I'm right in saying, aren't I? And how do you see that sort of cash level developing this year? Do you think oil is still a good area to get into?
Very much so. So on the first point, Jeremy, is that valuations are extremely low. So we're talking single digit multiples on energy businesses. The second point I think is maybe even more relevant is that while energy was so at a favor, in fact, it was really in depression from 2015 to 2020. We might recall that in the first half of 2020, we actually had oil prices go negative. So this was the really dark days. But can happen often in history, never let a good crisis go to waste. I think energy businesses during that period really right-sized their operations, really drove down their leverage, and positioned themselves for this recovery in both oil and natural gas prices, where they're now sitting on significant levels of cash, very low debt levels, very low payout ratios. So in fact, one of our core holdings in the portfolio, a company by the name of Whitecap Resources, it just reported its quarterly results a few days ago, and we're anticipating that company to bump its dividend somewhere between 25 and 30% over the next 2 to 3 months. So that's really indicative of the type of cash flow that these companies are generating. And I think it's also caused them to reprioritize how they allocate cash flow. Prior to 2015, there was a movement among most producers to put money back into the ground and increase production. And they've now rethought that strategy, partly because investors like ourselves are more focused on shareholder returns. So they're now prioritizing debt repayment and returning money to investors by way of higher dividends.
So just to wrap everything up then, how do you view the rest of the year? I mean, macroeconomically, we've been hearing some reports to suggest that central banks are beginning to think about taking their foot off the pedal in terms of interest rate policy. I've yet to see any evidence that inflation is slowing to that degree yet. I don't know whether or not you've got a view on that. But my view is I think that perhaps maybe markets may be moving a little bit ahead of themselves. I'm just interested to get your feel for the rest of the year and how you see things developing. Increasingly, I think that people, consumers at least, and possibly corporates as well, we're going to have less and less cash around. A lot of us are paying down an awful lot of debt, of course, and that's something else that's got to be sorted out. But inflation, to some degree, I guess, sort of makes that a little bit less onerous. But nonetheless, at the same time, it is very difficult out there for so many very different sorts of people and corporates. How do you view the investment opportunity from this point on?
I think the best way to describe what's happening from a macroeconomic standpoint is that the fight against inflation isn't over, but it's certainly starting to tilt in favor of slowing the rate of increase on interest rates because inflation has come down, but it's certainly not been arrested. And I would also say that there is somewhat of a distinction between what's happening here in Canada and what you're seeing down in the US. You just saw a PCE number in the US that was higher than expected. And then I think if you look at futures who are forecasting out the terminal rate, they're probably closer to 5.5% today, whereas a month ago that might have been closer to 5%. The difference in Canada is that earlier this year we saw a rate increase of 25 basis points, and the Bank of Canada came out explicitly saying that we're now going to pause for at least the next several months any further rate increases and determine how the Canadian economy is going to react. And I think that signal or that more explicit statement from the Bank of Canada is giving some preference for investors to areas that have really been neglected in 2022. And maybe the most important for us and most important for our fund is the property sector, because it really did languish in 2022 because of significant and rapid rate increases and the fear of an economic recession. We think the economy is slowing. We don't see a hard landing here. And with rate increases now starting to plateau, we think property in particular, Jeremy, is very well positioned. It trades at a significant discount to NAV. We're seeing dividend increases just in the past few weeks on the back of some very strong quarterly results. And it's a significant overweight for us in this portfolio, which we think is going to deliver both high levels of income as well as capital appreciation in 2023.
I always like to end an interview on a positive word, and I think that sort of sums it up, really. But Dean, look, thanks indeed for joining us. It's a pleasure to be able to catch up with you again.
Thank you.
That's Dean Orrico. He's the fund manager of the Middlefield Canadian Income Trust.